Good afternoon, ladies and gentlemen. Welcome again to this afternoon session of the conference. My name is Karel Lano. I'm coming from the Center for European Policy Studies in Brussels, which is a think tank. We employ about 50 people. We cover a lot of economic policy issues, but also institutional policy matters. And we have been following also, as many of you, the financial crisis, the sovereign crisis, very intensively over the last years. And you can find many of the papers which we've published on that subject on our website, so they are freely downloadable. And we are one of these many actors in the EU which tries to follow the debate, influence the debate, give opinions about what is going on. And I think also we have been influential as a think tank in proposing solutions. We are just preparing our annual report, which will be released next week. We have our annual conference, but I think as a think tank we have always tried to remain constructive on Europe and try to say, look, even in the deepest of the crisis, about a year or a year and a half ago, we said we need to go on, we need to find solutions. And I think one of my colleagues, Daniel Gross, was behind this idea to create a fund, a kind of a European fund to support national governments in trouble, which I'm trying to remember the name he gave it initially, but we have here somebody from what is now this European IMF, so to say, represented in our panel. So that's why I think, let's say, it's very useful that we have this panel now this afternoon. This morning we heard a lot of institutional perspectives. We had excellent speakers from ministries of finance, from European authorities, from the region here, but also from in Brussels, to give you an insight in how they have dealt with the crisis. But I think now this afternoon in this panel we will have essentially an interaction between, on the right side, the markets, on my left side, two institutions which have been dealing with the crisis, but from an operational perspective. And that I think is very interesting, also revealing for you, because many people do not fully understand how these bond markets function. And I think that was one of the revealing things of this crisis, that people have started to understand how important markets are. It's not that governments can have whatever levels of debt, which you would sometimes think to believe if you hear policymakers speaking. No, there must be somebody to buy that debt. And that's, I think, what we have clearly realized over the last 2 or 3 years, but which is also not a recent problem, which is a very old problem, which dates back from many hundred years. I visited 2 weeks ago Firenze and the Uffizi, and if you see all the wealth which you have in that museum, it's basically because the Medici were a bank at that time for many governments all over Europe, and even, let's say, had almost the same position as bankers have until today to governments today. So I think that's why it's useful that in this panel, and that's why I thought we probably start with a view from the markets. And my first question was, as we also heard this morning, please no complacency. My question is, what is the reason for the current calm in the markets? We see that debt continues to grow. We saw, for example, only 2 or 3 days ago, the figures for Spain, which are getting to be staggering. We also know, let's say, that we are now clearly in a second dip. We have the double dip. We spoke about the double dip. We are now clearly in the second dip. Why is it, say, that there is this current calm in the markets? And what could be the next phase of stress? So what could trigger next problems in the markets? What could trigger again these yields to increase, or will it remain like it is? So that's what I would like to ask the two market representatives. I have, like they often call it in these conferences, a buy-side and a sell-side representative. A representative from a big fund or an institutional investor, BlackRock, and then a representative from a large bank, which is, I think almost the largest bank in the world, JP Morgan, to give their view on that. Probably I'll start with Gianluca from JP Morgan. Gianluca, if you probably also say something briefly about the bank and where you're working in JP Morgan and what you're doing with, and then probably on that first question.
I think I was the appropriate person to be invited here because I'm head of Eurobond strategy at JP Morgan. I started a few years ago, and for many years it was a fairly boring job. And over the past 5 years, I've become the center of attention within the organization. And you realize that what was considered to be a safe, boring, liquid asset class has transformed into something that is incredibly exciting with ramifications not only for financial markets, but for the life of ordinary citizens. So I think the way this panel is set up is very interesting, because we have heard a lot in the previous discussions about the relationship that is not always very easy between politicians, what they can do, what the population will accept. There is an even wider gap between how policymakers tend to look at problems and how markets react to problems. So in my brief intervention, I would like to give my perspective on this relationship, which of course will have implications on what I believe will happen in the future. I would take a very quick historical detour. Financial markets are not irrational. You tend to look at the period between 1999 and 2007. You were looking at intra-EMU spreads that were very tight. I think there were some good fundamental reasons. Countries qualified into the EMU, they were seen to be on a path to become AAA countries. So that was the idea and the spirit of Maastricht. At a technical level, you clearly had the largest creation that you can imagine, a pan-European market in financial securities. When you look at market technicals, you had, for each government bond market, 20 primary dealers willing to provide liquidity with essentially zero bid-offer spreads. In addition, you were transitioning to a world where the equity market was becoming a lot less important for insurance companies, pension funds, and really government bonds were king. If you look at what happened in the post-Lehman, the world changed completely. You realize that some countries were giving misrepresentation of their actual fiscal position, but even more importantly, the focus on fiscal rules was only partial. Countries like Ireland and Spain didn't really have trouble with markets because of their fiscal position, but rather because of private sector imbalances. When you look at the process of pan-European markets creation, that became a problem when non-domestic investors decided to dump the government bonds. Primary dealers that were fighting to get market share, given the fragility in banking sectors everywhere in the world, were not really there to fulfill their mission as providers of liquidity. And finally, when you think about incentives, you had some players in the market that you can call fast money investors that could see all these imbalances developing, and they were happy to take part in the game. This is the story, I believe, that runs until the early months of 2012. What happened last year was a combination of factors that caused the massive rally you've seen until now. First of all, never forget the macro adjustment. I think the message that comes from this conference is all euro area countries have worked very, very hard to address the macro shortcomings of the past. In terms of fragility of the banking sector, we have worked very hard to recapitalize the banking sector. Primary dealers are able again to provide liquidity in the system. There was one big problem with the institutional framework of the Eurozone, I believe, or one of many. The lack of a lender of last resort. ECB people probably don't like to be considered lender of last resort for governments, but if you consider that there is conditionality attached, so it's good lending, you've seen that the reaction is market participants no longer see like a free option to go against countries. They realize that the market is protected by the ECB, by the EFSF, the ESM, and of course, this has created a much better equilibrium. Does it mean that we should be complacent that everything has been sorted out? No, but I think at least from a market point of view, we can survive without the very far in the future idea that Eurobonds are needed. You've heard of the political discussion before. There is still a very, very strong sense that this outcome is years in the making, if at all. I believe even without the idea of Eurobonds in the short term, we can have a fully functioning market where there will continue to be differentiation between countries, hopefully shrinking over time because the macro divergences shrink. So our view for 2013 is a cautiously optimistic view, and is based on the idea that there is cooperation at any level between the institutional players. So conditionality when needed, and ownership of the process of adjustment.
Okay, thank you, Gianluca. I think that's already a clear answer to my question. Probably I move to the buy side, a big institutional investor. Also, Joseph, if you say something briefly about BlackRock first, and then see whether your view more or less coincides or matches the view of Gianluca.
Yeah, so BlackRock, it's quite easy to introduce. I think it's the biggest institutional investor in the world, about $3.8 trillion under management, obviously split across different asset classes. So fixed income is still quite a large part, but it's only about $1 trillion. For us, Eurozone was always a core market, so there was never a question whether we are going to leave Eurozone or not. Many of our clients are from Eurozone and they invest in Eurozone, so that's where the mandates sit. The question was more, what do we buy in Eurozone? And I think when Gianluca was talking about the beginnings of Eurozone, it almost came to my mind to do the comparison that before we were trying to second guess which is the next country to join. Now we try to second guess which is the next country to get into trouble. So from spread tightening to spread widening, but for me the whole crisis has two dimensions. One is what have been discussed excessively already in this conference, and that is the policy and regulatory adjustments that are bringing across the labor reforms, new fiscal rules, etc., which is, yes, that is the solution to the crisis, but what we tend to forget many times is that market moves much faster than a labor reform can actually try to bring some green shoots. So the second part to fighting the crisis is really, as Gianluca said, the lender of last resort. And in a very simple terms, the market needs to see someone with deeper pockets than the market players to actually safeguard the market, which is for Europe, that is ECB at the moment. In US, it was Fed. I think the reason for calm in the market at the moment, while all the policy initiatives are going forward and are extremely important and positive, what we see in Europe is really the OMT program from ECB, which was introduced in July last year. I think that is finally a step which does give investors some kind of a fear to be short markets and to bet on countries getting into trouble. I will let my colleague František speak more about it, but from a market perspective, this was really one of the game changers we have seen in the market over the past year. There have been more time buying before by ECB. We have seen the LTROs and we have seen the very first intervention in the Greek market in 2010. All of these steps are there to buy time for the policymakers and regulators to actually step up the effort and come forward with more integration on the Eurozone level. I think the topics we have on the table at the moment, which we will touch upon during the discussion, are all very important to actually make it into the legislation, that the countries have all our control on the fiscal side and they actually commit to fiscal discipline. It is not always only about austerity. I think what we need to find a solution in Eurozone for is, for example, SME sector lending, which is one hugely underserved market, I would say, partly because of the problems in banking sector, where the institutional investors can help, but they can't do direct lending, so we need to have a vehicle for that to actually provide money this way. So I think that for all these steps to take in place, ECB has done the right thing to buy us the time. What we have to make sure is that not that there is complacency in the market, that actually there is not a complacency on the policymaker side, and that we don't tend to think that, okay, now we are all safe because ECB is there, because that is not the end game. The end game is to really come out as a stronger Eurozone, and actually a Eurozone that does have backstops in place if things go wrong. But quite frankly, over the last 3 years, we have seen many times when ECB bought time, the political initiatives just kind of went away, at least from the press. There was probably a lot of things done behind the scenes. It just, the urgency wasn't there. So I quite understand the view that a lot of the core countries have, is that the elevated spreads are actually a good thing, because they do push countries to implement reforms. Without that stick, there is really nothing much within the current Eurozone setup that can actually force a country to do adjustments. Yes, market tends to overreact. What we have seen over the years, the tight spreads before and the ultra-wide spreads we have seen at the end of 2011 or in mid-2012, that was excessive volatility, what we don't want and what is counterproductive. But I don't believe that going back to ultra-tight spreads over German bonds is what it will look like when we are done with the crisis fighting. For that, we would really need to see some sort of debt mutualization, which is not on the cards at the moment, and is not absolutely necessary for the European Union and Eurozone to function going forward. So I think I will stop there. There is complacency, maybe in the market sense, but the market does have a big buyer in the house. If the need is there, we have to make sure there is not complacency on the policymaker side, that we stop doing the right things.
But if I follow the debate a bit in Brussels, or I see what is happening in the member states, I mean, I see a bit more complacency now. As I said in my note to you, for example, these proposals on the Eurobond market, which were reform of the Eurobond market 2 years ago or a year and a half ago, were very acute, with these proposals on the blue bond, let's say on debt mutualization. No, for my part, it's like since 6 months they have disappeared. So my question is to both of you, apparently you say, look, this quiet phase which we have today will continue. Notwithstanding for me what I say, continuing increase in debt at important levels. The second dip very clearly now, let's say Germany minus 0.4 in the last quarter. Also other countries, we were waiting to see the figures, so I think they will be also a negative. So what could provoke a next problem?
Well, do we need a next problem? We still have a problem. So I'm not sure we need to provoke a next problem. I mean, we have obviously important elections, as was mentioned, coming up. But what we really need to make sure that the deadlines on the policy changes are made. So we have a deadline of January 2014 when ECB should become the single supervisor. We have subsequent deadlines or a soft-spoken deadlines when the policymakers would like to have a more functioning banking union, which I quite agree that it does seem as a big hope at the moment, as there are too many countries against that. When we start missing these deadlines, that is when the next pressure point comes. Aside if we get a very unpleasant political surprise in some of the countries that have elections. But I think that the market is aware of the fact that things are moving the right direction. Not the investor community is really suffering from low yield environment in many of the core countries. So they are incentivized to look outside. So as long as we manage to keep the pace of the reforms as it at least was up to now, and we don't backtrack on the ECB commitment, the volatility should be tamed. It doesn't mean that yields cannot rise by 50 basis points. What it means is that yields will not go to 8 or 9% for a peripheral country that easily. But the second we start missing deadlines and we come out and say that, oh, actually we don't need banking union because it is very inconvenient for some of the member states, that is when the markets will again start questioning, okay, can we sustain this? And the answer will be every time you have to sustain things again, it's more and more difficult. So it took buying of one country in 2010 to calm the markets. Then it was a huge amount of liquidity that the central bank had to come into market for 3 years. Now it is a program for program countries that want to regain market access or regain market access. So the question is, what is it that it will be the next time that the markets will be actually taking for a sign that things are improving again? And I think it will not be short of QE. So.
Okay, thank you, Joseph. I mean, one question, I think, let's say if you speak about, we are looking outside the Eurozone for high yields. If you look to Spain and Italy, you have very good yields. You have between 4 and 5%. So probably, yes, if I could turn the question around to Gianluca, I've heard the representative of the Ministry of Economics from Spain speaking this morning. He says, let's say, or 5% is still far too high. if I heard him speaking this morning. Do you see this further coming down or not yet?
I think talking about the risks to a more positive view, there are some risks, but they seem to be manageable. You can talk about a political risk in Italy. If you have uncertainty on the creation of a new government, you have some uncertainty of the path of consolidation in countries like Spain. But I think by and large, they are on the right path. The banking sector cleanup has happened, and I think the rest will be incremental from here. There is an issue of negotiating a new package with Cyprus. But according to our analysis, if there is enough goodwill, and again we go back to politicians accepting what is the best need for the region as a whole, this is something that can find a solution. When I look at yields for Spain are in the process of coming down steadily, not in a straight line. You have bumps on the road, but the idea is that you can clearly see that commitment from the region in terms of a change in the institutional framework and commitment at a country level are pushing markets in the right direction. So our working assumption is that spreads will continue to decline.
Okay, thank you. I think a clear message from the markets. We turn to the institutions or to representatives from institutions which have played a big role into that. On the one hand, we'll say we have the sovereign central bank, somebody working in the risk department, meaning those which do the operations with the bank in the country and look at the collateral and provide liquidity to the banking system. Then Joseph, Rolf from the ESM, the European Stability Mechanism, this new institution which was created, which was mentioned by the previous speakers as being extremely important, let's say, to show there is a buffer. So I want to give them both a question. Let's say, what have you been doing over the last years? Have you seen this improvement, and what do you expect now to come? Let's say, are these institutional foundations so important? Also the way the ECB has reacted, or the ESCB, let's say, with all the national participating central banks in reacting to the needs in the financial sector, and probably also when will the OMT be used? Because Joseph was mentioning the OMT as an important development, but we haven't seen it used yet.
Okay, thank you very much for giving us the floor. I would just like to correct you that I'm from Slovakia, not from Slovenia. But anyway, that's not so important at this stage. At first, I would like
Did
to...
I say Slovenia? Sorry.
Yeah.
Anyway, I meant Slovakia.
Slovakia. It's not... we are get used to it. At first, I would like to warmly thank to the Center for European Affairs for inviting me here to this conference and giving me the opportunity to share with you my thoughts about the current state of sovereign crisis in the European Euro system and toolkit used by the ECB. As you know, the present European crisis has its roots in a failure of European Union institutional design. The economic and monetary union adopted in the 90s implied an extensive monetary union, but not an economic one. There was no fiscal, no banking union, no shared economic governance institutions, no coordination of structural economic policies. The lack of pressure to create an economic union during the years of expansion didn't move Europe to this goal. Everything changed with the crisis. The turning point, as it seems to be now, was in the unfolding crisis was the speech given by Mario Draghi, the president of the ECB, at the Global Investment Conference in London in July last year. There are two main messages of his speech. The first one was, quote, "The ECB is ready to do whatever it takes to preserve the euro," unquote. The second message says that the only way out of the current crisis is to have more Europe, not less Europe. A Europe that is based on four building principles: a fiscal union, a financial markets or banking union, an economic union, and a political union. This means nothing more and nothing less than that much of what is at present national sovereignty is going to be exercised at supranational level. Common fiscal rules will bind national government actions. In banking union, there will be one supervisor for the whole euro area. In order to cope with the risk aversion factor or counterparty risk, when one bank is afraid of not getting the money back from other, the ECB from August 2007 launched a long range of non-standard monetary policy measures. 3-month, 6-month, and 12-month long-term refinancing operations, known as LTRO, with fixed rate full allotment, refinancing and sterilizing, fine-tuning operations, Covered Bond Purchase Program, and Covered Bond Purchase Program 2. On May 2000, it implemented Securities Market Program for Greece, Ireland, and Portugal, and reactivated this program again in summer 2011 with the inclusion of Italy and Spain. Národná banka Slovenska, as an integral part of the Eurosystem, actively participated in these programs. But all these measures turned out to be not sufficient enough to stop the rise in the yields of countries in concern. According to the market perception, the ECB was well behind the curve and sovereign spreads continued in their rise to levels at which some governments were practically cut off from the market and others could refinance only with serious problems at elevated prices. So the ECB had to do something more, and at the end it decided to use, I would call it, weaponry of higher caliber. In December 2011, it reduced the minimum reserve ratio from 2 to 1, unleashing liquidity of 100 billion euro. The Governing Council of ECB also temporarily expanded the list of eligible collateral. Instead of scheduled 1-year LTRO, ECB launched the first 3-year LTRO, and in February the second one. Via these two tranches, the ECB injected into markets over 1 trillion euro. Both tranches have the prepayment options, which can be exercised after 1 year. Just as I speak now, from the first tranche, it was already repaid 150 billion of euro, and the deadline for the first bids from the second tranche is just today at 5 p.m. The market expectations for the size of the prepayment are ranging from 120 to 150 billion. And now let me come to the outright monetary transactions, which were already mentioned by Joseph. On August 2nd, the Governing Council of ECB announced OMT program in secondary sovereign bond market. The program, if ever, will be conducted within the framework of conditionality, which means strict and effective conditionality attached to a EFSF ESM macroeconomic adjustment program. Transactions are designed to focus on the short part of the yield curve, in particular on sovereign bonds with maturities between 1 and 3 years, and which is of utmost importance, no quantitative limits are set on the size of the transactions. The Eurosystem accepts the same pari passu creditor treatment as all other private creditors, which, as you all well know, was not the case of the SMP. All purchases will be fully sterilized, and aggregate OMT holdings will be published on a weekly basis. The previous security market program was consequently terminated. After the announcement of technical details of OMT in September, the spreads of government bonds of periphery countries over the German benchmark continued to shrink, and nowadays they are at their lowest level since mid-2011. But where we go from here? The latest ECB non-standard monetary policy measures, especially the announcement of OMT, evidently helped to ensure price stability across the euro area. They also contribute to improving the economic environment. But completing the task of economic renewal demands continuing action by the governments of the euro area. Governments have to set right their public finances. It is governments that must reform their economies. Though all this is easier said than done, fortunately now it seems things start to move in the right direction. Deficits are being cut across the whole euro area. The peripheral economies are gaining their competitiveness. Official figures appear to suggest that these countries are successfully restoring competitiveness through internal devaluations. Since peaking in 2008 and 9, whole economy unit labor costs have fallen by about 14% in Greece and Ireland, 7.5% in Spain, and 2.5% in Portugal. Current account deficit of these countries improved substantially. Export volumes are rising. Another milestone is the creation of single supervisory mechanism. At the peak of the crisis, the interbank market was not functioning, so the main aim of the ECB was, and still is, to repair this financial fragmentation, where markets were functioning very little within each country, but not across countries. One of the reasons is that national supervisors have asked their banks to operate their activities within national boundaries only. This situation is going to be changed now, hopefully early next year. To conclude, markets are much more relaxed now as they were about a year ago. Is there anything what could trigger the next phase of stress? Sure there is. The main danger is still the inability of European governments to fulfill their obligation to have more Europe, not less Europe. The governments have to persuade the market, not by words, but with concrete deeds that they are serious about doing their homework. I would say I'm cautiously optimistic about the recent recovery in financial markets. The cost of financing for sovereign concern has been reduced substantially. Even Ireland and Portugal regained access to the financial markets. Definitely, we are not out of the woods yet, but I think we can already see a dim light at the end of the tunnel. Hopefully not the headlight of the approaching train. I think I will stop here.
Thank you, Frank. That was, I think, a very good view, let's say, which coincides, let's say, what Gianluca was saying, let's say, rather optimistic of the further phase of the market, probably also meeting his view, let's say, that, for example, for Spain, let's say, there could be further decline in the spreads with Germany. We have another institution present here, let's say, which is this new institution, European Stability Mechanism, which was also mentioned already as being fundamental, let's say, to what we have seen over the last months, let's say, this relative calm in the markets, and it was formally established in October, if I remember correctly. But I still have some questions, which I mentioned in the mail to you, because I see we have been debating this morning, for example, are we moving to a more federal model in Europe? But if I look at the ESM, for my part, it's a bit a mixture of being an intergovernmental organization. It's instituted by an intergovernmental agreement of all the member states who signed up to this, basically from the Eurozone. But it has some federal elements in it as well. So how do you see the ESM operating in the months and years to come? Rolf?
Thank you very much. And also thanks for the center for inviting me to this presentation. Well, let me start off a little bit by how I see the evolution over the crisis of the institution per se, and then answer your question. I think if you look at the evolution of EFSF and ESM, it comes a bit down to what was yesterday evening said, the known unknowns and the unknown unknowns in a way. When the countries came into the crisis, which was a situation that was not foreseen to happen, then they realized that there is a problem and they need to cope with this, and this urgently. So it was known beforehand that if it would ever happen, one would have to do something. The solution wasn't quite clear from the start. And then very rapidly and very efficiently, the EFSF was created. Maybe the unknown part of it was that there was a misassessment of what is actually needed, in a sense that the initial idea was the idea of a firewall, which is kind of a nuclear deterrent. So you set it up, you never use it, you never need it. But I think the point there was that it was underestimated what is the size that market would request in order for that firewall to actually hold and being a nuclear deterrent. So from that perspective, then I think we have moved to something that I would rather call kind of a powerful, efficient fire brigade, if you wish. And that is, I think, a more telling model in this respect. Now, what we got then is we came from a temporary institution that was set up in a rush to a public international institution that you said, that is based on public international law, backed by a treaty, intergovernmental treaty. It's powerful in terms of size, if you wish. It has the 500 billion, and it is compared to the EFSF that was based on guarantees from member state. It has a stronger base in terms of capital, having a capital base. So it has 760 billion of paid-in capital, of callable capital, and 80 billion of paid-in capital. And it's there to operate permanently. The way it operates has also evolved or the way the ESM is designed and the EFSF was modified has also developed over time. The EFSF started off with what one can say is as a baseline, the IMF model, which is a well-known fact. So countries run into trouble. They get off the market for some time because market doesn't have the patience of looking through the necessary forms, and you need some intermediate finance. And that comes from the official side. And that is how we started off with giving loans to Ireland and Portugal. That is also what ESM can do. There are two key elements, I think, that one needs to point out that are really crucial, that applies to everything that EFSF and ESM do. The first is the kind of the baseline that in principle a country has to be sustainable, has to be in a sustainable position to receive support. The second point is that any support is linked to policy conditionality. So there are sometimes there's a lack of clarity on whether this applies and how it will apply, or how it will apply in the future, of whether Spain got an easy access or whatsoever. Whatever EFSF and ESM do is linked to policy conditionality and is linked to an MOU. The evolution, however, that took place, and why I think that EFSF and ESM now forward-looking is kind of an efficient fire brigade, is that some tools were added, and those I think are very important to consider, because they are, on the one hand, they are efficient. On the other hand, I think they are very suitable for the market situation that we see and how we will be maybe operating in the future, or what may be the challenges in the future, which are the tools that were put in place in order to help and reassure market access. And here we have the contingent credit line, which is kind of, as it says, a credit line a country can have and can draw on in case there's a need. And this, among others, can be given by way of primary market purchases. The idea of primary market purchases being to support a country in market access, so we can, the ESM can buy up to 50% of a new issue. Not buy everything, that would be a loan, but buy up to 50%. So the country by itself has to have some market access. The third tool that was created is the indirect bank recapitalization tool. This is, in a way, the presumption here is, again, to be efficient in order to address a specific problem which may emerge in the financial sector, but by doing so also allowing the country to stay in the market. And get otherwise its finance. And we have seen, I mean, it's clear this is what now is applying to Spain. And we see it working in the case of Spain. So from that perspective, we have now a variety of tools that can help in different situations in an efficient manner without going back to the, if you wish, old style IMF model, that the country first has to really get into crisis and fully drop out of the market before you can do something. Now, the other tool that was created and is in our portfolio is the secondary market purchases, but I think here is also the point that this was created at a time when the ECB's role in terms of what the ECB would do in the secondary market was not clearly defined. Now this is much more defined than at the time. And forward-looking, the question would be whether this and how that tool would be used, or what kind of the complementarities would be. The ECB itself has, as František said, defined the conditionality, so to speak, attached to the OMT with a view to the contingent credit line or program conditionality altogether, not with a view to the ESM engaging in the secondary market in parallel. I think this is, for me, in a way, it's also a good model forward going, if I hear what Gianluca said and what Joseph said, in terms of that we move into a different environment, into a new normal, if you wish, where you will see credit spreads, where trading sovereigns will remain credit, not only interest rates. Because forward-looking, then, the two things that were also pointed out by the others is there will be, if this is the case, there will be some market discipline. You will have to have reforms, continued reforms if something happens. That is what is, so to speak, enshrined in our operation. The second point is you want to remove uncertainty, or maybe reassured that you don't get into excess volatility again. And here again, I think by, if you wish, in this model of being in an efficient fire brigade that can step in if there is a shortage of liquidity for a limited period of time and can back up a country, support a country, that I think is one additional tool to help to remove this uncertainty also, so to speak, under the new normal. without thinking that it is the all and forever deterrent firewall. And here I think the final point is, and that's something that was discussed a lot this morning, is this question about banking union. For us, immediately, that is the discussion about the direct bank recapitalization tool. Evidently, at this stage, we cannot say precisely how it will look like, because that is still to be negotiated and still to be found out. But for me, it comes into the same kind of category. What it does is, it again removes the tail risk that emerge. And in that sense, it's helpful. At least this is the intention that was clearly formulated by this phrase of breaking the vicious cycle. And so in doing so, it also is a tool that helps stabilizing financial markets.
Thank you. I mean, that was, I think, clear. I think maybe a bit technical for the audience. Certainly, both presentations, let's say, about the tools which the ECB or the central banks are using within the Eurozone, and then the tools which are at the disposition of the ESM. But, I mean, I have two questions, let's say, which I hear, let's say, which I have, let's say, when I hear you speaking. First of all, I have the impression, let's say, that in the end, a country, if it doesn't find a market anymore, it could have all its debt purchased by, on the one hand, the ECB through the OMT and by the ESM. Could that be the case? And then probably secondly, if I see how your decision-making will work, the ESM is an intergovernmental body, has mostly to decide by unanimity. It may have a supermajority, whereas the ECB is a federal organization which will decide just by majority. And then the problem I then have, of course, and as we have seen reflected in the newspapers over the last months and also 2 years, is that certainly some countries say, but I have only one chair, one vote in the ECB, and then the ECB is becoming, on top of that, no longer independent, but the ECB is becoming a fiscal agent. As you were saying, we have conditionality. Can the ECB, basically, because of lack of other institutions, we're relying on, for that kind of issues at least, on the ECB to be the fiscal agent. So, is this possible? First of all, let's say that a country can have its debt purchased by the ECB or the ESM in the future. And then secondly, couldn't we have, let's say, kind of some problems occurring in the future because of differences in decision-making between both bodies?
Yes, I can reiterate what I said, that the OIT program was scheduled or was designed to help the countries which have this type of problems. But it is really, it is based on this strict condition attached. The first thing what the country has to do is to ask for this help. Without this help, there is really not possible to start this altered monetary transaction program. As you probably you well know that in the last year, the fall of the last year, there were some rumors about the Spain, which was supposed to ask for this type of transactions, but fortunately the situation changed. The yield went down, so there was no need. And even in the case when this altered monetary transactions, if they would start, there will be periodical assessment of the situation by Troika if the country involved does meet the criteria, the conditionality criteria. It will be done on a periodical 3-month basis, and if there is no convergence or if the goals are not met, the OMT program can be suspended. So it won't go forever.
So it's that this OMT will not only be ECB, it's also ECB in cooperation with the Troika, if a decision is taken, and of course ECB has to protect its own capital base.
Yeah, sure.
Rolf?
I mean, from our perspective, what one can say, I can perfectly imagine a situation where the two intervene at the same time. So again, if, as František said, we, for example, if the situation were that we would have an enhanced condition credit line in place that offers the possibility of primary market purchases, we could go in the primary market and support a country maybe in issuing bonds, if you wish, from 3 year up, because the ECB had said they intervene only up to 3 years. That would be something in our mandate, and then again, it's fully up to the independence of the ECB to decide, and at that stage, whether they do want or do not want to offer OMT or to intervene under OMT. But if they decide to do so, you could have the two things in one go. What I do not see as kind of a key of a baseline scenario that in parallel we would also do SMP. There would, from my perspective, just economically, financially be the question of efficiency of then two actors intervening in the secondary market, but in principle that's possible. Even that would be possible, that we have in parallel as a secondary market purchase on our side with a horizon above 3 years. I mean, we are not in that respect limited. Now, the other point that you mentioned about the decision-making structure, well, if you think, so to speak, purely institutionally, it's clear that the unanimity principle that we have and also the linking back to the national decision-making processes is just in theory, it's a curse, it's a burden, or it can create quite some costs. And from that perspective, simple majority rule or other international institutions like the IMF or the World Bank have could be more efficient. At the same time, one must simply understand political reality, which is that these are big amounts of money, where it is very difficult for the shareholders not just to delegate the decision. And the second point of that reality, however, is also that so far we have still always taken a decision when it was necessary. It wasn't always easy, and you have to tweak things here and there, but so far, when there was a need, programs have been decided upon. It could have been sometimes maybe a little bit faster, but it worked. And I would also say for me, there is one important element that comes to it is, I mean, you didn't make the point, maybe I can refer to Jörg, who on another occasion made the point that, well, by linking also the OMT to more explicitly to structural reforms, in a way, it's becoming more political than it may otherwise be. So from that perspective also, I understand then by subjecting the support of OMT to the condition of an EFSF program, you're also subjecting, the ECB has subjected itself implicitly to this decision-making, to this kind of backing of the procedures that indeed you need to follow up with the fundamentals, you need to follow up with the reforms, and then you have also, you want to tie this in, which is a strength eventually of the approach.
So there is something in the new institutional structure as a result of the crisis, which I'm starting to discover, let's say, this kind of integration between ESM and the ECB and then the existing institutions in Brussels on working out solutions for countries in problem. Any reactions from the market side? Are the bazookas enough? I mean, I'm impressed to hear it again. Let's say how big the bazooka is. I mean, this is what they called the bazooka. They are represented here in this panel. And that's what they were called in newspapers. Any reaction from Gianluca?
I think it's interesting to run the parallel between the sort of protection we're getting for the rates market and what has happened for a number of years in the FX market. When you look at FX intervention, either to defend a currency from depreciation or appreciation, markets tend to pick up very, very quickly if a commitment is not strong enough. We have the example of the Swiss National Bank when they tried to intervene the first time to protect the Swiss franc from appreciation. At first it didn't work. Then they needed to come out a lot more forcefully, and the peg has held very, very well since. I think the perception that market participants have is that euro area policymakers are showing a very strong commitment. You could have a doubt at the beginning of the crisis if some of the players were serious. I don't think at this particular time you have any concern that this is not the case.
So Gianluca, I would say it's not the total amounts of the bazooka which matter, it's more the credibility behind. Meaning it's not the 500 or the 700, it's the credibility.
It's a combination of the two. But clearly, the idea that the ECB has moved from something that was self-declared as temporary, without clear rules of engagement, to something that is supposed to be there, and they're ready to stand by it. And similarly, the FSF as a temporary institution, we don't really want to lend money to the other countries to something. We need to be able to provide support if needed. I think that provides additional strength.
Joseph?
I think for SNB and the FX pact, the key word was unlimited. So from my point of view, the only institution with unlimited balance sheet is ECB. So that is the institution that has the credibility to provide the backstop to the markets. Now, it's obviously a step in the positive direction that we managed to actually come up with 700 billion of lending power combined EFSF and ESM. The only concern is that it's unfunded. And we see that, I think the Spanish bailout for banks is a perfect example. The funding is coming from ECB at the end of the day. So it's again down to ECB whether they will be willing to accept the increase in the balance sheet and the repo operations. We have seen periods of time since the EFSF creation when EFSF couldn't access the market. And pardon me for saying, but I'm still somewhat skeptical that if it comes to primary intervention, for example, for Italy, and ESM needs to buy 5-6 billion on one day, that there is readily available market funding for this. Now, this all might sound very skeptical, but I think it's all very interlinked to the fact that, we can create a lot of creative solution when it comes to long-term lending, but when it comes to market intervention, that is a different topic. That's why I think the OMT is so important. Not saying I think what from ESM, from the whole tool sheet which we have on the disposal, for me the key is the direct bank recapitalization, which we seems to be backtracking from again. But I think that is one of the key features that actually could help to contain the crisis in Eurozone and could actually help with the banking union and create a level playing field for banks, which then in return could actually solve the also well-heard complaints about corporate lending rates in different countries. But I remain a bit skeptical on the immediate firepower when it comes to quick market intervention. I think for that, the ECB is the place where we need to be comfortable with the commitment, and I agree with Gianluca, the commitment seems to be here for the time being, but yes, we know there are times when the politicians tend to upset the ECB board members, and they tend to be very outspoken about how things are not moving in the right direction. So I think when you ask what are the potential risks, this is, as I said before, but backtracking and slowness and not doing things which actually market things are.
And we see this already a bit now, but I mean, I wouldn't agree with your point, let's say, that there is such a fundamental difference between direct recapitalization of the banking sector and what the ESM has done in the case of Spain. Does it matter, these details, whether it's recapitalized through kind of an entity in Spain or whether it's done directly by the ESM?
I think it matters greatly for Spanish government, which are liable for that 100 billion potentially lended.
But if this is a way you can square the circle in Europe, let's say, to make it acceptable for the ESM.
But then it comes back to the discussion about that sustainability. So if it's really only a question of liquidity within Eurozone sovereigns, then it's fine. If it's a question of solvency, then we are just worsening the problem by actually forcing the government to underwrite the bill. I mean, we have seen what happened in Ireland when the government underwrote the bill with the much better fundamentals on the fiscal side than where Spain is sitting at the moment. So I think it would have been a big change if that bank recap was made direct as opposed to guaranteed by the sovereign.
Any reaction from Rolf or František on that? On this issue of ESM, I mean, that in the end that comes back to the ECB, not to the ESM, as Joseph was saying.
I mean, from my perspective, what Joseph said kind of confirmed what I eventually said at the start, is that, well, if it is that, I mean, initially one had the idea of the EFSF being the firewall, and one did not appreciate that actually what is requested by markets, by many market participants, to have this kind of unlimited size. Whether this is realistic or not realistic to have it and to burden it on the ECB, at least, I mean, similar to foreign exchange interventions in a central bank, in principle, it's unlimited, right? That is what maybe what matters, and that we don't provide. We provide size, but not unlimited size. I mean, in that respect, I cannot disagree. I mean, it's a perception that is out there, and that one has to handle, and that we are not eventually are not made of, and that I think is also clearly communicated. The other point about Spain and about direct bank recap, I think one should also not overdo it. I mean, I cannot directly speak for Spain, but if I look objectively at the case, and I mean, the amount that is now used, and according to the program, scheduled to be used for Spain for direct bank recap is the 41 billion that were paid. That's it. That's 3 or 4% of Spanish GDP. Well, that doesn't make the country an unsustainable case in any way. So I cannot prejudge what will be the decision forward-looking, but like just creating the expectation or the need for every country to come in on this, because it had indirect bank recap to also have direct bank recap, is at least economically not, I would not even see from a sustainability perspective kind of a necessary condition or assumption.
I think we can equally argue that maybe the 41 billion is not enough, right? But I think that's really a different topic than
Yeah,
what
exactly.
we have
That's
here.
another discussion.
And I'm not saying that there is a better solution than what ESM is doing at the moment. I think that's it's definitely a better world in Eurozone with and without ESM and EFSF as well. I was just making a point about the readiness of the funds to be deployed into the market, and we have seen. EIB was close to losing market access at the end of 2011, which is an institution that was established for many, many years. Everybody knows that. Everybody around the world has credit lines for them, yet their spreads went from plus 20 to 120 in 10 years, which might not seem like a big move, given where Spain and Italy was trading at that time, but for a AAA, super safe, super sovereign issuer, that is a big move, and a lot of people are sitting on serious losses on their portfolios. They basically just stop buying. Exactly. So that is, I think that's one risk, which is not very visible when the markets are okay and functioning. EFSF can now place 3-4 billion issues without a lot of problems at very interesting spreads. Yet when the crisis was really at the peak in November 2011, that wasn't the case. So maybe I think that the funding structure has changed, and when ESM came on board, it has changed as well. So there is a potential of doing not matched funding, which is great. Then I think obviously a lot of voices out there will be saying that it creates also a lot of risks when you refinance long-term lending or long-term buying with short-term funding, as we have seen in 2008. But I think the bottom line is that we are all the time going around the topic, and for the time being, all the funding is actually coming from ECB in one shape or form. So we know that ECB wasn't comfortable when Spain wanted to inject directly government bonds to Bankia for the recapitalization. Somehow things changed when it was Sareb injecting bonds, so it's fine. But there is a certain amount of pushback that ECB can create in the market. So for me, the key is the commitment from ECB, and the commitment seems to be there. Which is fine. With that commitment behind, I think there is a lot of things that ESM can do. If ECB would say, I'm not willing to accept the ESM bonds which are being used for Spanish recapitalization, then we have a problem.
Yeah, but that would be very surprising.
Yeah,
if the ECB were not to accept the ESM bonds.
Well, they refused to accept Spanish government bonds because it was close to monetary financing. So I think it is a different topic, but. There is clearly, I think for me it's quite clear. Maybe it doesn't seem that clear from other angles, but it's really the keys are held by ECB.
Okay, thank you. I look at the audience for questions. I know this is probably a more technical subject which we have been discussing, but I think very vital for all of us, because it certainly affects the degree to which governments will come to see us to ask more from the taxpayers. So who has questions? There's a question there from Peter Spiegel, and then behind Peter there's also another question, so I take them all, and here from Francesco. Yes, please, you identify yourself, please.
Hello, my name is Juraj Karpiš. I'm from think tank based in Bratislava. I have a question related to this OMT program. I would call it the Draghi put. My question is, do you have any worries about negative effects of this presence of central bank in sovereign bond markets as a lender of the last resort? And I mean, are you worried about mispriced risk and misallocation of capital? Thanks.
Yeah, wait, we will take probably 3 questions. Peter?
Peter from the FT. And it's a very similar question, if I can ask the market guys to address this. Joseph, in particular, you liken the ECB's OMT program to quantitative easing by the Fed, but it is on its face not quantitative easing. It is the strengths described on the right side of the panel actually, to some respects, are its weaknesses. A, it is subject to political approval. I mean, you cannot get OMT until you get a credit line from the ESM, which means this is going to be debated in the Bundestag, and we're going to have to talk about Finnish collateral and all these things. So when the ECB goes to pull the trigger, we have to have a political debate before that happens. So this is not the Fed or the Bank of England intervening. This is the market's going to have to wake up one day and realize actually there's going to be a big, messy political debate before this happens. The other thing, which is another feature which was talked about on the right side, is it is not like a currency intervention where it is unlimited. Every quarter, the ECB is going to stop and say, let me see if the conditionality has been met. So we intervene, we stop, we evaluate, we intervene, we stop, we evaluate. I mean, this is potentially, and I'm not sure the markets understand this yet. This is not an Anglo-Saxon intervention into the bond market. This is going to be a very different animal, and I worry a bit that if Ireland, for instance, requests an OMT program sometime in this year, and the realization that this is not a quick and easy central bank intervention comes to fruition, the safety net that we had established that was now the be-all and end-all for Spain and Italy, the holes will be obscene. I'm just curious whether your clients and whether you think the markets fully understand how OMT is actually different from what the Fed and the Bank of England are doing. Thanks.
Thank you. And probably another question here from Francesco, who's, by the way, who was before the Director of Operations or Director General of Operations in the ECB, who dealt with all of these issues.
Yeah, and of course I'm not speaking as a former Director General, but just as a free observer. And I have two questions. The first one is whether we can say that ESM, EFSF, to some extent the OMT, are an answer to the criticism that was made many times towards the currency union, that it did not have a mutual insurance mechanism. Can we say that the FSF, the ESM, to some extent the Eurosystem funding, provide some kind of a mutual insurance? So what is provided in the United States by the federal budget, is it provided to some extent in Europe by the EFSF, ESM, and Eurosystem funding? This is my first question. My second question is whether there is an agreement that the OMT worked so fine because it came at the right moment. And what I mean by this, it came when substantial progress had been made already in correcting some of the problems that had emerged with monetary union. So a lot had been done to correct the macroeconomic situation, the macroeconomic imbalances. Quite a lot had been done in terms of institutional innovation on the fiscal side, on the banking side. Quite a lot had been done, as I said, on the mutual insurance mechanism. So is there a feeling that if the OMT would have come in the autumn of 2010 instead of coming in the summer of 2012, it would have not had the very favorable effects that it has had? Indeed, in my view, it would have been a disaster, and it would have destroyed the credibility of the ECB. From this point of view, I think that conditionality of the OMT is a strength. It's not a weakness of the OMT itself, because it says that you need two blades to a scissor to cut: adjustment and funding. So these are my two questions. Thank you.
And on that last point, I would add, because there was an argument from a well-known Belgian economist, Paul de Grauwe, who said the ECB should have intervened much earlier. So by which you have responded to this, say the ECB could have only announced its OMT once it saw probably certain positive moves in the markets already. I mean, Paul de Grauwe already published a piece in the Financial Times, I think in August 2011, said it's only the ECB which can solve this crisis. but it took a year longer before the ECB really announced what it was doing. If we probably start with the market people to react, because there were two specific demands to the markets also about this issue. Can we compare the EU and the US? I mean, and it's not so easy as it seems, but also, is this a mutual insurance mechanism?
Can I just clarify the point I was making? I wasn't saying OMT is same as QE by Fed. What I was saying, if OMT, the time that OMT bought is not used well by the Eurozone politicians, the next round of what the ECB will have to do will be again bigger. And in my thinking, that would have to be the QE. So I wasn't saying that we are at the QE point yet at the moment. I was saying that it's probably, if we don't use this time well, then that's where we're gonna have to be next time the market puts pressure on the sovereign financing. But sorry, I was jumping in front of you, just to make sure that...
I wanted to reply to Francesco's first point, which I believe is key in my view. The way the Maastricht vision of the Eurozone worked was flawed. The focus was on some of the macro variables, especially fiscal variables and inflation. There was a complete disregard of private imbalances. So this is what I call model risk. If you assume that something will work in such a way and you don't allow for the possibility of having to adjust, then you run into trouble. The system is too rigid. The way I look at creating firewalls is understanding that reality can be more complex and unknowns compared to what we had in mind. It's very easy to blame Greece for some of the problems that they have introduced in the Eurozone, with a lot of complacency elsewhere. I find it a lot more difficult to blame countries like Ireland, where the common wisdom was, guys, you're doing a fantastic job. A banking sector that is 9 times the size of your GDP is not an issue. So I really welcome the fact that we're working in the direction of creating a region where you have a safety net. And I agree very strongly on the point that if you want to have support, you need conditionality, because there is an important issue of credibility. The timing of intervention by the Bank of England, by the Fed, has been completely different. Some people refuse to call it debt monetization. The way these interventions have been promoted are not to support directly governments that otherwise would have difficulties funding in the market. For instance, the Bank of England has focused on one variable that is not really tracked anywhere else in the world. I want to promote M4 growth. So the timing is very important. If you were to start, as Francesco said, we have a problem. Let's use the magic balance sheet of the ECB, you would have created massive problems of a moral hazard. And I think the beauty of the European construction is that you've been moving always forward for 60 years, sometimes very, very slowly, sometimes adapting to a crisis much more quickly, but with the idea of being realistic about what can be done, and being realistic in a context of many countries, different central banks with one central bank at the top, so the Euro system, different incentives, doesn't really allow for a very fast response. On the question of conditionality and how important it is for market participants, I think it's very, very hard to find a solution to the euro area crisis if you don't assume that the countries involved will behave responsibly. So my working assumption is that any country that goes into a program will not have any difficulty in reaching a successful deal, and this will be evident in the market. I cannot really foresee how Ireland, after what they've done in the past 3 years, doesn't satisfy any or some of the conditionality that it would be imposed upon them. But as I said before, I cannot really think this region can work if you don't assume some sort of stick and carrot, yes, but at the end of the day, good faith from the countries.
Let me maybe just add one point on the readiness of OMT. I mean, my understanding is that Spain has signed an MOU, so it's really the ball is in the government court. If they ask for the activation of the program, this should be quite straightforward. When we come to Ireland, I don't really think Ireland needs OMT. A country that trades 90 basis points over Germany in 2 years is perfectly fine from the monetary perspective when the base rate is at 75. So I don't think there is any reason why they should be activating the OMT at this stage. And they also have an MOU signed as well. So I think it's, but I think ECB was quite frank in saying that you need to have market access to be eligible for OMT. And it's really for the markets, this is not a question of Ireland, this is a question of Spain predominantly if we see a trouble, and then subsequently Italy. I think Portugal is sufficiently small that can be beneficial from this, but it's not really the focus of the markets at this stage. So I'm quite a bit more optimistic than Peter on the readiness of the tool for the country that is actually the most discussed one and was already discussed for a couple of months, that they are imminent to ask for help. But maybe František
František
tells me something else.
You probably want to react on some of the points which were raised, or Rolf?
Authorized monetary transactions. If I understood the question correctly, if the ECB is not afraid of mispricing of the security or something like this, about pardon me? Mispriced. Okay, what's the reason of the authorized monetary transactions? It's to allow the government which are in crisis or in bad financial shape to get to the market, yeah? to lower the rates and allow them to finance themselves. So that's the main aim. And the governing council, of course, on a regular basis, they assess the situation and change their behavior. They can stop the intervention if they found that the prices are really out of the normal or out of the macroeconomic fundamentals. So that's their role to not to allow the really strong mispricing, and they have to follow their road, their goal to allow these countries to finance themselves or the market.
František, you had a response to Francesco's point, let's say that on the ECB, that it could only, on this conditionality as well, that it could only act when it saw already things moving in the right direction, that it could not have acted, say, for example, in 2010 November, but that it has to see things first. Otherwise, the OMT wouldn't have got the effect, or the announcement wouldn't have got the effect?
Yeah, sure, of course. I don't think it was a question or it was a statement by Francesco. I think it was the statement. So the answer for the question, you already said it.
Okay, Rolf, on the ESM and the kind of also the conditionality, and is this, can this function sufficiently rapidly?
At least in principle, it can function very rapidly. I mean, if you look at the guidelines, for example, for the secondary market purchase, there's an obligation to complete the process of the MOU within 2 business days. So we have made, I mean, some things can be done very rapidly, and member states are in principle committed to that. I think more generally, to the point that Peter made, I mean, I think you can neither apply for OMT nor can you apply for quantitative easing, right? It's all in the discretion of the central bank in any case. And there is where the decision is taken eventually. Second point is, I also, again, with a view to the speed of decision and the noise around it. Yes, it's true, there's probably a lot of noise when you have to take the decisions, and this may not be very comforting, but in the end, the Bundestag so far has approved programs and has approved it with a broad majority. It's not a given, but this is what effectively has happened. We will need no further Finnish collateral anymore also. So I think we are not running into an impossible situation. If you can think about a lot of obstacles, but when it comes to the point, I'm still confident that decisions will fall in place. The other point that was raised by Francesco about mutualization, I think that's perfectly right what you said. You can think of it in terms of a mutual insurance mechanism for, so to speak, the extreme cases. It's different from what was discussed this morning, that you have kind of an insurance for smoothing out business cycles, right? Because that would require more permanent fiscal intervention. That is really a different kind of animal. But as such, it's a mutualization in terms of insurance for crises. It's not, and that point I want to make, one should not misunderstand it as a mutualization of liabilities. At least so far, the country is always asked to pay back over time, and we can have a very long horizon, but eventually the liability stays with the country.
But to that point, EFSF bonds are not mutually guaranteed by the participating countries. Each one guarantees only its share. ESM is a bit better. It does guarantee up to the capital which the country provides, but basically none of these bonds is a liability of one country, right?
There's no joint liability.
Exactly. So I was a little bit lost with that, with the question on the guarantee, but on the insurance policy. But I think that's probably that is the one step forward that will bring us closer to that mutualization if these institutions would be mutually guaranteed.
Is there a further 2 questions or so? We still have time for 1 or 2 questions. If somebody has any other point on all these acronyms which have been using, which for us are very well known, but I think are essential for you as well. If not, let's say I had another point, probably, or 2 other points, probably also to the panel. First of all, let's say on the ESM, it may be interesting, Rolf, if you give us some figures. I mean, you have this total amount, but how much have you funded, or have you standing out in the markets today? Do you know who has been buying this debt? Have you got also international interest? We know that at some stage Van Rompuy went to China to ask to the Chinese, please buy your debt, and it wasn't very successful. And I heard rumors that the Chinese bought it. Is it true? Is it not? I don't know. But also apparently the Japanese are a big buyer on that side. And then probably on another issue on the Spanish deal, but also I could ask the market participants, I mean, has this not increased moral hazard? I mean, which is a bit of debate in Germany, which we have. Let's say, is this not dangerous? Say what we are doing in the case of Spain, which is also behind a piece from, for example, Werner Sinn 2 weeks ago in the FT, saying, look, this is extreme. I mean, this opens the gateway for all the banks in Europe.
Well, on the first part is that for EFSF we have, I mean, first the funding program has changed, and I think we have now a pretty robust funding program where we have short-term funding, and we regularly go to the markets with 3 months bills and 6 months bills. And then we have the long-term funding program. For EFSF overall, about 900 investors have participated in our auctions and syndicated deals. The investor base per se, like about 75% is pension funds, central banks, so real money investors, sovereign wealth funds. The rest is others, hedge funds, other funds. We have the participation of investors geographically has evolved somewhat over time. We had initially a very strong base in Asia. That was also partly due to a clear commitment by the Japanese Ministry of Finance. That has then, in the course of the crisis, somewhat diminished, or actually substantially diminished, particularly when there was the uncertainty period at the end of 2011, early 2012, but has recently strengthened again, so that overall we still, I think, 25% go to Asia. Of our bonds. One point I wanted to make, because Joseph made it before, in terms of issuance and how our bonds are used. So you know that we do lots of issuance directly to the market, but we also do this quote-unquote payments in kind, where we send EFSF bonds to Spain or to Greece in order to finance bank recapitalization. What is clear is that simply, I mean, the amounts that are requested in the short run for those kind of recapitalization activities, they are too big to be placed in the market. And for that purpose, but in order to make the funds available, we therefore send our bonds, and then under certain conditions or certain floating interest rate bonds so that they preserve value. That we have done in size overall. We have issued last year 150 billion altogether, and a big part of that then as bonds going that were used for the Greek PSI, that were used for the Greek bank recapitalization and for the Spanish bank recapitalization. The point that Joseph made, that eventually also those bonds end up on the balance sheet of the ECB, we actually receive quite some interest from and questions from banks, so they are also repoed with private banks. It's not only, and there's quite also for those bonds a liquid market at the moment, so it's not that everything necessarily ends up with the ECB, but there's quite some active trading in the financial sector as well.
Gianluca or Joseph, how much have you bought from the EFSF? Do you know how much BlackRock has or JP Morgan?
I guess we can't comment on the holdings, but
I thought you were entirely transparent as a US-based institutional investor.
To our clients we are, but not to the markets, right? I have to say that from my point of view, I like the ESM structure more than the EFSF structure, and we haven't seen much issuance out of ESM yet, except for the bill program, which now you took over from EFSF. So that is probably something that we are waiting for. In terms of, I really can't say the total sizes, but it is less than bonds from, for example, EIB.
And about the moral hazard issue, which I raised in regard, is this increasing moral hazard in the banking system?
I don't really understand the obsession with moral hazard when you're facing a crisis of these sizes. So, if there is a better solution than to recapitalize Spanish banks, then very happy to look at it. But
to let them fail, Americans would say we haven't let enough banks fail.
Americans did let over 100 banks fail, but all of them were very small. So they didn't.
One was big and painful.
Yeah, that is true. But obviously we don't want to go back to those days. So I think yes, if I have to sum up the Spanish bank recap, there was clearly a number of banks which could have been let go without major problems. The decision in Europe, quite frankly, is that, and it's not really a market decision, that nobody is allowed to fail, and you can't push losses anywhere else than on sub-bondholders. Even that has to be somehow watered down. So that is the doctrine that we are working with. It's clearly not the time now to say that some of the big Spanish banks which are in problems should be allowed to fail. I think the negatives out of this at this stage are much bigger than the moral hazard which we are facing. And quite frankly, I think we have passed the point of letting banks fail with the Irish blanket guarantee in 2008. That was probably the point after which we couldn't let anything meaningful let go, because everything was intertwined with sovereigns. And I think, as many good things as we said about ECB today, it is clearly one of the big institutions that was pushing for this policy was ECB, that didn't like to see the value or the collateral which they're taking in repo operations being questioned at all. So nothing above sub-debt was allowed to go under. And we have seen the Danish banking system trying to come up with a resolution mechanism, and they did push losses on, it was small banks again, exactly. But they did push losses on senior bondholders. And my meetings with them, every time I'm really surprised. They tell me we only can go on roadshow to US. They can understand the concept of bondholders facing losses. The second we start talking about it in Europe, we get kicked out of the door. So it is what it is, and I think.
But in Spain we have done it. In Spain with the subordinated debt holders.
Subordinated debt holders, yes, those are touchable. But if we are talking about moral hazard in Spain, clearly we are not saying that all the banks are fine after we haircut it 10 billion of subordinated debt, or 5 billion from Bankia, a couple billion from other banks, right? We are talking that actually the losses were much bigger, because that is the moral hazard, right? If this was enough, we wouldn't need the recap. So that clearly the losses were far outweighing the size of the sub-debt market that was in existence, and the equity market. So the losses would have to go all the way out to seniors, which wouldn't be enough probably. So we would be looking either doing something which ECB would absolutely hate, touching covered bonds, or touching deposits, which then anyway would end up on the sovereign balance sheet. So I think there is obviously moral hazard, but it is, for me, it does look very inevitable at this stage that this was done. And I think, quite frankly, personally, I think that the bank recap wasn't of the size that I would have thought is necessary for Spain.
Okay, Gianluca, you still have a comment on these issues or not? I mean,
I think if you want to be a purist, you don't fight a crisis, because we've seen so many walls that we established that have collapsed. There are some potential negative consequences. We didn't really address the issue of the action that central banks can have to distort financial markets. In some cases, the action is what they want to achieve, so repricing the curve of risk-free or perceived risk-free assets to stimulate the economy. These are actions that, by and large, are very, very untested, and we live extraordinary times. No one has a crystal ball. You have to take decisions, and the worst thing you can do is to avoid taking decisions because you are unsure about the future.
So both market participants are fairly, happy with the rather pragmatic approach of, let's say, the policymakers. František, you still have...
I would like to comment this.
But anyway, you can be happy with what they're saying.
Yeah, sure, of course, I agree with Joseph, but from my point of view, I would like to comment.
Any other questions from the audience? We're waiting, by the way, for the Commissioner Šefčovič to arrive. That will be immediately the next panel, but he has not yet arrived, so we are waiting. So you have an opportunity to raise some questions, so please don't be afraid of your ignorance of what we have been debating. You can raise your questions as you want, because how central banks operate in the markets, I think, is essential, but is not sufficiently understood. And
Maybe a coffee break?
Sorry?
Maybe a coffee break?
No, but I prefer, let's say, me not to have a coffee break, so because I think the Commissioner is under time constraints, but he has not yet arrived. So who has any other points wants to raise to the audience? No questions, so then I will have to leave it here, and we'll have to wait for the Commissioner to arrive. But anyway, I thank all four of you, let's say, I think I found it an excellent panel. Sorry, it may have been a bit technical, but it's essential. It's part of the core, the backbone in which we have been tackling this crisis, and I think both sides were very complementary. Let's say the market people also saying, look, supporting what the institutions have been doing. So from my side, thank you, Rolf, František, Gianluca, and Joseph for this contribution. I think it was very useful. And so please give him an applause.